Trade has been the dominant market theme, maybe along with the Fed, in 2019. Is trade still going to be the dominant market theme in 2020?
Well, Dom, absolutely. You're going to continue to see ongoing stress and ups and downs when it comes to messaging from Beijing as well as Washington. They have kicked the can of uncertainty down the road by 2 to 3 months. But overall, they have not solved the trade issue. Hence the reason why we think it's going to continue to be a drag and concern on investors in 2020.
All right, so let's talk about the idea that it will be a drag. We had a pretty banner year. 19 record closes for the Dow, 32 record closes for the S&P 500. There's been no doubt the force has been with the markets in 2019. The driving force behind that has been some of these tailwinds from the Fed everywhere else. Now, as we talk about the economy, is it still going to be good enough to sustain that move that we've seen?
Well, that move has been a real historic move, up close to 30% on a total return basis. And we don't believe you're going to get that type of return in 2020. But overall, we do think that you're going to get a positive return between 5 and 7%. And that's based off of our assumptions of 2 to 2.5% GDP growth here in the United States, and roughly global growth around 3%. Again, not rambunctious growth, not rambunctious earnings growth overall, but again, a positive.
So then how do we position? I mean, you're a portfolio manager. Your job is to allocate money. As you go into 2020, knowing what you know for 2019, how do you then position? Is it mostly in stocks at this point? Do you look at bonds? There's an argument that both are overvalued at this point.
Well, there is a low return environment for both bonds and stocks, and we do agree with that comment, Dom. But one has to realize that a 6 or 7% return in equities beats the rate of inflation, and that's why one is invested in equities over the long run. So we would be balanced in one's portfolio, overweight U.S. equities to start the year, and potentially fade that trade into more international equities. You just want to be in quality equities that are rising dividend companies that don't have a lot of debt on their balance sheet.
What types of companies are those? Just out of curiosity,
Yes.
the names and maybe the industries they operate in?
Yeah, so industrials, we have a 2x weighting in industrials. So we like United Technologies as well as General Dynamics. We think those two companies over a 3 to 5 year period, one can do very well. When it comes to consumer staples, boring companies like Hormel, I kid you not, and Pepsi, we think you can do very well there. And then consumer companies like Disney and Walmart, if you have a 3 to 5 year time horizon, then those companies can provide good returns with less volatility than the overall market.